we're in a place where some of the biggest problems in the economic fundamentals are coming to a head, and we have to make decisions as a country of what we do with those. So when inflation increases the amount of wage growth that employees are experiencing, the natural outcome is declining quality of life for Americans. But where we're at today is a lot of big money is avoiding the stock market altogether, seeing it as not a route to have access to the best opportunities. So then the question is, where are those best opportunities? We are seeing overwhelmingly those are shifting to a private dynamic.
We are back with another exciting episode. I think you're going to really enjoy this one because we're going to dig into some details on the economy and raising money and marketing. We have a guest that's been on the show before, so I'm super excited to have him back. Now, he is the fixed income GOAT. I don't know if that's self-titled or if someone gave you that name, but definitely he understands real estate and raising private capital, marketing to potential investors. He's been doing it a long time, over 200 million in assets under management, and he's back to share some wisdom with us. So welcome back, Nic DeAngelo.
Kevin, good to see you again, my friend. I think the problem is I hang out with a lot of syndicators, and so fixed income might be a little bit of a different route than they go a lot of the time. But yeah, we love the fixed income space, especially in today's market. And my friend, it's always good to see you and be back on the show.
Yeah, I'm really excited to have you because I did listen to our episode from about 18, 19 months ago, and we really dug into some details on the economy, and it was very interesting to get, I think we agreed on almost everything, but very interesting to see what actually happened over the last 18 months. So I'm excited to catch up on that and how things are going, man. So catch us up. What have you been doing the last 18 months?
Yeah, so last 18 months, lots of has happened in the market, lots has happened in the economy, lots has happened with Saint during that period of time. What we've been seeing is a lot of craziness across the board. We had a handoff from the Biden era to the Trump era, right? Both sides were or still are pointing fingers at who's the problems for what sources, et cetera. And what we're seeing today, most recently, is this interesting place where the Federal Reserve is in a bit of a pinch here. They got to catch 22, right? They have job reports coming out. They're a little soft. And they have inflation that whatever index you're looking at, whatever metrics you're looking at, is closer to 3 than it is their target of 2. So on our side of the coin, we've seen a huge amount of investor interest on fixed income because there's just a lot of question marks in the economy. I have a lot of friends in multifamily and kind of across different asset classes. We also play in industrial historically quite a bit. And those sectors are all, very, very market dependent. And there's a lot of misses that people are having, on big high profile deals. So I still like fixed income the best in, this market environment. I still have a lot of question marks as it relates to the Fed. And, I'm happy with some of the economic decisions. I have question marks and I'm scratching my head on others. So what's happened since then, I think, is we're in a place where some of the biggest problems in the economic fundamentals are coming to a head, and we have to make decisions as a country of what we do with those. So that's what I'm seeing over the last 18 months as we went from, the post everything bubble where everything was returning record profits, everything was killing it, everything was doing amazing. Now we're in a more inflationary period. Now we're in a unemployment and employment crunch period where a lot of that demographic and dynamic has changed quite a bit. So a lot's changed. And now as a country, we need to pick some paths.
Okay, there's so much to unpack here, man.
So much there.
This is cool. This is really cool to have you back on. So for anyone who did not check out the episode with you on it before, and they're just tuning in, they haven't met you yet, we probably should have done this first. But tell us who you are, and then let's get into. You said problems you're seeing, so I want to dig into that right away. But tell us who you are first.
Sure. My name is Nic DeAngelo. I am president of Saint Investment Group. My background is I kicked off my real estate career in the marketing space. I was doing heavy internet marketing for a couple high net worth individuals, and I ended up working with 2 family offices to manage their acquisitions. That evolved into asset management, taking over their asset management. And then eventually over time, I started Saint Investment Group, and we've been focusing on working with retail and high net worth investors to really provide, unique acquisition solutions, et cetera, in the market. What we found was that fixed income was our bread and butter. It was something that we had a lot of high net worth, sophisticated individuals that was missing. So since that point, we've been focusing on the fixed income component and really long-term growth strategies over time. So we're very long-term thinking. So we're obsessed with the economy. I can give you all kinds of war stories of why that is the case, but we're very clear on what our goals are and what we're tracking in, the economic environment. So we're economics based, we're long-term thinking, we're super pro and bullish US. Let me be clear on that. However much I beat up on the US or whoever's sitting in the chair of president or whoever's sitting in the chair of Federal Reserve, I am very bullish on the US over the long term. So it's just sorting out some of these midterm and short term problems, I think, that we have our eye on the most. So that's kind of me top to bottom.
Okay, so a typical listener might say, "Okay, you're saying fixed income. We want to understand that. That should be. I think most experts would agree you should have some fixed income in your portfolio for proper diversification." Okay, that's very basic. But I'm just curious. When I think of fixed income, I immediately go to debt, like US treasuries, maybe corporate bonds, something I could buy in my Fidelity account. But I think what you do is a little bit different than that. So, can you help us define what fixed income is since you've used that term a couple of times?
Sure. So fixed income is, an investment that you make that pays a fixed return over a period of time. So it's something that you can expect on with a much higher degree of certainty than, say, equity investing or something that's a growth perspective where you're betting on appreciation or you have other things going into the cake that are less fundamental to the investment strategy. What we focus on specifically was we were tasked with figuring out what we felt was the number one asset class in real estate that could perform on a fixed income basis. What we found was single family housing. There's all kinds of fundamentals there. There's the fact that, in the US, we have a housing shortage of about 6 million homes. There's the fact that since the post 2008 crisis, that the U.S. government has gotten so involved in the mortgage market that they own, guarantee, or insure at some point of the life cycle over 80% of mortgages within the U.S. There's the fact that if you look at the mortgage market of the U.S., the vast majority are 30-year fixed rate terms. Nowhere else in the world is like that whatsoever. They have various models. Some utilize pieces of that, nothing like we do here. So what we found was a perfect combination for what our investors were looking for. What we do is invest in mortgages backed by single family homes with the idea of, 10, 20 plus years of stabilized income on the back end. So there are growth strategies in this market today that are amazing. And there are amazing providers of those. We liked our approach to fixed income because that's what our investors were looking for, our class of investors. So there are fixed income opportunities like treasuries. What we find from our investment group, hundreds of people, what we find is that they don't like that margin, right? Because we're talking 4-ish%, right? Whatever day you look at it, it's roughly 4-ish% on treasuries today. And then we have inflation at 3, right? So 1% is really your net-ish there. So our investors are much more bullish on real estate. They're much more open to the private investment markets. And so they're looking for something to offset risk, right? Simply put, they want a higher return. They believe that offsets more risk as long as it has solid fundamentals backing it up, than having a 1% margin for error on treasuries. Because again, if inflation spikes or we see tariffs or we see trade wars or if we see literal wars, all that could be underwater and your bonds are underwater. So that said, we focus on higher yield. We focus on real estate backed. That's what we always play in. And I like that model the best personally.
Yeah, and you and I, this is why we get along so well because that's
Yeah,
the
totally.
business I'm in too, right? We're a
Yep.
single family home debt business as well. It's easy to get those higher returns, and it's backed by real estate, not the government. So it's not 100% guarantee, but it's getting close. I mean, you've got to be careful what I say, but we've never experienced a loss to an investor in 17 years. But it is possible, right?
Sure.
I don't know why I'm going off that little tangent there, but yeah, I agree with you. The real estate fixed income is the way to go, and especially in the stock market. So you said compared to the stock market, because you did say that there are some problems that you're seeing, and I think you were going towards that, but I'm not sure. So maybe I'll let you elaborate there. What kind of problems are you seeing in the economy.
So let's beat up the stock market for 30 seconds just
Okay.
because it deserves it, right? But I love the stock market. I think historically the stock market was the great diversifier. It was the great access of everyday investors to be able to invest in a market with hundreds of companies, thousands of companies that they had access to. That is a big deal, and that's democratizing access historically. We don't see that today, right? We don't see that today. Let me clarify and quantify that. Since 1995, we've seen the stock market reduce the number of companies by somewhere, I think it's like 40% less companies since 1995. So, on a just numerical numbers, data driven basis, the stock market is declining and rapidly going backwards. During that same period of time, private investing now owns 6x the number of companies. Okay. So, there's goods and bads there, right? Just like anything in the investment world. The good news is that companies are still existing, right? We're not talking about a shortage of companies here. We're not talking about a shortage of successful companies. What we're saying and what we're seeing are that companies don't want to go public. There's all kinds of reasons. We could dig into regulations and headaches along the way and the advantages of working with private equity across the board. But most importantly, the stock market is not what it used to be. It's not this great diversifier. It's not the greatest place for access for investors that are looking for that. Not only that, there's bigger problems. We know that the Magnificent Seven represents at any given point, if you look at the last year or so, roughly 35, 1/3-ish% of the value of the stock market, of the S&P 500, excuse me. So now we're seeing diversification getting beat up even more. It's not as diversified. It's 7 companies that represent a third of the market. There are all kinds of graphs that if you overlay and pull out the Mag 7, the average company is making 2 to 3% returns. Again, we're back to inflationary numbers. They're not even beating inflation. So I could talk about the fact that if you look at the things like the CAPE ratio, if you look at things like the Buffett index, the Buffett ratios, et cetera, you're looking at an average stock market overvaluation of 38%. Meaning,
Ooh.
if stocks were to drop 38%, they would be on track with historical norms, meaning completely average priced. That scares me. I was previously a stock market investor quite a bit. I'm not putting money towards stocks for that. And then if you look at the broader economy, which supports the stock market, the reason that the stock market grows, we have new concerns. We have, again, inflation. I've been talking about this for a long time, screaming at the top of my lungs that inflation has increased wage growth. Okay. So when inflation increases the amount of wage growth that employees are experiencing, the natural outcome is declining quality of life for Americans. So in that case, people are more strapped for cash. People are not able to make their expenses happen as much. They're pulling back on consumerism, things like that, which largely fuels the economy. That does not bode well for publicly traded companies specifically. So, and again, I could keep going forever on this. It's something I'm really passionate about because I really believe the fundamentals of the investment world have changed. So we're stuck between a rock and a hard place there. We also are now seeing employment numbers that now that they've been adjusted, we're seeing roughly 20 to, in the 20 to 29,000 range of new jobs created every month for the last handful of months. That is terrible, right? That's extremely low. We're used to seeing in the hundreds and hundreds of thousands. So now that we're seeing tens of thousands, massive reduction there. We're seeing unemployment with a small spike from the target range to the Federal Reserve targets of 4%. We're now starting to see up to 4.3. We're also seeing, again, slow job growth and job creation. So that's likely to go up over time. And then we also, on the other end of the spectrum, have what the Federal Reserve's dealing with on the inflation side. Their target's 2%. They're roughly about 3. So they're 0 for 2 on the only goals that they have on the Federal Reserve side. So what
That's
I
right.
believe happened on the last rate cuts is that Jerome Powell had to make a decision. And he had to choose supporting the labor markets or supporting, the currency markets and the finance markets, aka inflation. I believe he chose the employment markets this time around.
Okay, there's a lot to unpack there. Let me go
Yeah,
back to the stock market
sure.
quickly, and then I want to get to the dual mandate. So you said you referenced the Buffett indicator, which for the listener is basically how large is the stock market as a ratio to GDP. So it's just one thing. It's just one way to look at the market. If it's priced appropriately, over or undervalued. And Buffett was a big fan of this, right? So to give the listener an idea, and so I'm going to challenge you here, Nick, because the Buffett indicator says that the stock market should be roughly 95%. Some will even say less, 85 to 95% of GDP. It's over 200% of GDP right now. So you said about 30% overvalued. I could make the argument with this, at least with this one indicator, that it's over 100% uh, overvalued. So that'd be 3 times what you thought.
So the CAPE ratio was what I was actually quoting, that 38%. But I
Okay.
wanted to just throw other, factors that people could consider and look up. But yeah, way overpriced. You go ahead, not to cut you off.
No, that's. I was going to say, how do you feel about that? Because what you're saying is that there's a consolidation, and there's 7 major companies, at least in the S&P, which is the 500 largest companies, right? No diversification in the S&P at all right now because it's the Magnificent Seven. So you said it's not like it used to be. So maybe the Buffett indicator isn't as important. I don't know that. I just read that and it like scares me a little bit.
So if the Buffett indicator was the only thing that we were looking at, I'd say, maybe there's some other data that's, contradictory to that we could really dig into. But as you dig deeper, as we've dug deeper, that's just not what we're seeing. We're seeing that more data actually supports the Buffett hypothesis of it being wildly, wildly overvalued. I look at the CAPE ratio, the cost adjusted price to earnings, right? And what that over time says is that it's roughly, last time I checked in the last couple of weeks, 38% overvalued. So if stocks dropped 38%, they would be on track for historical norms. Nobody listening to this right now would be okay with the stock market dropping 38% and just saying, well, it's back to historical norms, so it's okay. No, that would be devastating. That would devastate IRAs. That would devastate 401ks. That would devastate the everyday investor in numerous ways. So then we take the Buffett indicator. Warren Buffett's sitting on what, roughly 283 billion right now. Is that the most recent? I think he spent a few bucks recently, but we're talking hundreds of billions that he's sitting on, and his interviews are not positive. He's basically saying he doesn't know where to put the money. And that's Warren Buffett. That's Warren
Yeah.
Buffett, Uncle Warren, the source of real, true market value-based investing. Can't find things that are worth the value. So my concern of what this means for everyday investors are that they're not getting the diversification, that the growth is more bubble-ish growth, right? Less fundamental growth, less value-based growth. And then on the back end of this, they have less access to things like alternative investments that are very clearly have value at the fact that they might have 4 walls and a roof, right?
Mm-hmm. Yeah.
So, and I think there's good trends on this. Again, I'm very bullish on the US. I want to say that. The bullish aspects of this that I would note, one, and I've honestly, politically, I am an independent. So I vote both sides of the aisle. I literally vote on whoever I think is best for the economy. So I'm happy to beat up Trump or support Trump where I think it's valuable. In this case, Trump has an effort for 401ks and IRAs and other types of retirement vehicles to have better access to private investing. That's been a big effort on their side, on their administration across the board. I think that's very positive. I think if we look at the trends, that if you look at the big groups, BlackRock, if you look at the big groups like Tiger 21, in order to become a member of Tiger 21, you have to have $10 million liquid to invest.
Oh, they just changed that.
Oh, did they? What would they?
Yeah.
Did they bump it
So
up?
it went up to 20 million investable
Wow.
cash, and then here's what they realized, Nick. Okay, so we want 20 million in investable assets to qualify, but nobody has that because they all invest their investable assets. So they just retracted, and now it's 20 million net worth.
Oh, okay.
So that's
So
new. That's new this year.
Moral of the story is we're not talking everyday
Yeah.
people. We are talking a sophisticated top 1% of 1% sophistication level, multi-generational wealth at many points in the Tiger 21 group. So when you're looking at these groups, you can literally find what these people are investing in. I would encourage you, Kevin, you'd get a kick out of this. Check out what the most recent breakdown of portfolio looks like for Tiger 21.
I did.
Did
actually.
you?
Yeah.
Did you? Okay.
It's heavy VC. I was very surprised.
It's up 6x the number of companies that are with different VC groups at different levels since 1995. So there's a lot to go around, and they've, have different strategies. But also look at real estate.
So we'll share the screen. I know a lot of people consume this in their cars on the way to work or whatever. So we'll just kind of describe for you what we're looking at. But he's going to pull it up here for those YouTube viewers so you can see what the Tiger 21 portfolio breakdown is. Yeah, this is what is cool about what Tiger 21 does is they have what they call portfolio defense. And every meeting you go through this, one person presents to the group, and it sounds like you just kind of beat each other up and try to become better investors, right? Investing is a big piece of Tiger 21. There's more to it than that, but that's a big piece of it. All right, so what are we looking at here?
So this is the most recent breakdown that we found. I think this is from earlier this year. This was from our a portfolio analysis, a portfolio strategy webinar that we pulled or that we created earlier in the year. So this is the breakdown that we saw when we pulled this. It's been maybe a quarter or two since we did this. 28% towards real estate, 28% towards private equities. Okay.
Right.
We're
When I
seeing
said VC, that's what I was referring to. It's either PE or VC. It all falls under this bucket, I think.
currencies only 1%, commodities only 1%, miscellaneous only 1%. So this is a pretty weighted, like pretty clearly weighted breakdown of where big money's putting their money, especially, private groups, family offices, wealthy investors, etc. So this is one. I love this breakdown. It just is so telling.
Yeah.
And
Where does crypto fit in here?
that's a
Miscellaneous, I guess.
good, I think it goes into cash and cash equivalents. I don't want to 100%. I'd have to look at the breakdown on our side. Again, this is from a couple quarters ago. This is from our, but we typically check it regularly. But this is the last time we broke down the chart and kind of added it to one of our presentations.
I mean, the
But
point is that the wealthiest people are not all heavy stock market.
not anymore. Not anymore, right? And at the end of the day, that's a big change. People are shifting away from the stock market being such a core approach because the mindset historically was, well, it's the stock market. You could choose this company and not choose that company, or you could choose this bucket of companies and not this other industry that you might not be bullish on. But where we're at today is a lot of big money is avoiding the stock market altogether, seeing it as not a route to have access to the best opportunities. So then the question is, where are those best opportunities? We are seeing overwhelmingly those are shifting to a private dynamic. And that's great on one hand because it's often better for the companies. They're choosing this. These private opportunities are better in many ways for that reason, but there's less access to Americans at the same time. So now we have a difficult situation for people in the investing world where they're likely going to have to roll up their sleeves and get a little more sophisticated with finding private investment opportunities like the big money guys are.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. Since you've worked with family offices, I'm curious about how that experience was and all of that. But what you're talking about here is more than likely accredited investors only.
We definitely, on our side, it's accredited investors only. That's an SEC requirement for how we structure things.
Mhm.
But also, it's just a matter of a lot of these investments. It's very hard to take, a million different $5,000 investments versus taking 200,000 at a time or 500,000 at a time. It's difficult just from an investor management standpoint. So a lot of these big groups are targeting accredited investors.
So for us, we have a Reg A, which is not unlimited non-accredited investors also. But to your point, it's much more administratively challenging. So we have to manage that, of course. But we have both options. But I do know that most people are accredited only. It's a little safer, less regulatory, less compliance. But Yeah, to your point, where are these investors finding these types of deals? Why don't I just ask you that question? Where are people finding these types of
Sure.
deals that don't want to invest in the stock market?
Sure. Word of mouth is still a powerful tool, not just for the funds and for the fund managers along the way, but it gives people a higher degree. It gives potential investors a higher degree of certainty, knowing that someone has a direct experience with a group. And then also it's the good old fashioned Google search a lot of the times. I know on our side that we're very active. We put out a lot of information. We put out a lot of education. That's a passion project. To be equal, to be clear, that's an equal part passion project and an equal part something for our company and that benefits our company along the way. But yeah, I mean, on our side, it's trying to give financial education, entrepreneurship, and then support things that we feel passionate about, like building a strong family dynamic, growth of our demographics in the U.S., things like that. That we're really trying to support people that want to go the right direction with those things.
All right, I want to get into the dual mandate because this is a concern that I have, and you already alluded to it. The Fed is in a tough spot because they're fighting two different battles here, and it's hard to win them both. In fact, we call that stagflation when they're both going the wrong direction, which is a concern of mine, by the way. But inflation, you've mentioned that a couple times, around 3%. So the way I understand inflation, there's two types of inflation. One is price inflation, which is what we're talking about here, CPI, PCE. But you also have the money supply. So if you increase the supply of money, that is the technical definition of inflation. It just happens to be when you increase money supply, you increase prices. So here's what my understanding is, Nick, that real inflation, just the money supply increasing, is closer to 5%. Actually, it's a little north of that. We're seeing price inflation around 3, which is what you've said a couple of times. So I believe that and I can make the argument that we're $2 trillion in deficit this year alone, and we have another 9 point something coming due at a higher interest rate, which we talked about on our last episode. So we might see 10 to 11 trillion dollars of new debt this year. That's inflationary as well. So with those two things in mind, I'm concerned that inflation might be rising in the near future.
I couldn't agree with you more. I couldn't agree with you more. Just to define the dual mandate, because you
Yeah,
alluded to it.
please, please.
Yeah. So the Federal Reserve, whoever sits in that chair, whether it's Jerome Powell or you go all the way back to Paul Volcker, or there's Alan Greenspan
That's way
somewhere in
back,
the
huh?
right. That's way back, but important. That's an important era. So whoever it is that sits in the chair of the Federal Reserve, in the Federal Open Market Committee, they only have two jobs mandated by Congress. One is protect employment. What that means is they're typically targeting a 4% unemployment. On the other end of the spectrum is protect currency, the value of our currency, meaning inflation, meaning they're targeting a specific rate of roughly 2% on the inflation side. Here's what we know, Kevin, with 100% certainty. We know that 80% of every dollar has been printed since 2020. We know that. Okay. Here's what we know is that $1 in 1913 is the same value as $100 today. We also know that our
If you
currency,
compare it, you got to compare that to something. So I'm assuming you're comparing that to gold.
I believe so. Yeah. I mean,
Yeah.
it just purchasing, it's just purchasability really.
Yeah.
But
Okay.
I would have to look at the exact parity there. But, and then the other is that we've lost over 85% of our purchasing power on the dollar since we left the gold standard in 1971. So we know that if you look at very wise minds in the US, let's go back to Warren Buffett, that, he has a famous quote that, and I'm going to butcher this slightly, but that the goal of any government over a long time is to devalue their currency to zero. Okay. That over time
Oh,
it
that's
benefits them
interesting.
to significantly devalue their currency, especially when you start getting into debt. Because, like you said, 2 trillion that we're in deficit this year, 2 trillion being added to the national debt this year alone, and that's expected to rise by the mid 2030s to 3 trillion a year on average. So we're going the wrong direction any way you cut it. We're not getting this more on track, it's less on track. So all that said, do I think inflation is going to rise? I think it's absolutely going to rise. I think the inflationary pressures are already here. I think not just because of our overprinting and mishandling of the budget, which is the very obvious one and very important, but also demographically, right? The US, if you look at things like demographics and population growth, we are on the tail end of the baby boomer impact on the job market, right? A lot of them are moving to retirement. We're over halfway through that. They're the largest generation we've ever had and the wealthiest generation we've ever had. They had a massive impact on the US, but they're over halfway moved towards retirement. So now we're seeing that this huge generation is leaving the workforce and they're being replaced by two generations down, Gen Z, a much smaller generation, a much smaller impact on the workforce. So you see labor rates going up. We also don't have the same demographics and population growth, right? Any population has a 2.11 fertility rate, meaning adult women that are having children have to have on average 2.11 children to maintain a population, break even on the population side. I think we're around 1.6, 1.7 today. So pretty notable, below the high water mark of what's needed just to maintain. So all those things are inflationary across the board. And then we add in things like tariffs. We have things like supply chain issues, potential wars, all of which are inflationary along the way. I think there's a lot of pressures on inflation right now in the upward direction.
Since we're scaring the shit out of everybody, let me
Yeah.
just share
Yeah.
something with you. The I saw this chart maybe 2 weeks ago, Nick, and it's about where other countries, not US, is holding their reserves. So every country has reserves, right? And it all comes back to the dollar. That's the reserve currency. We know that. But the other countries, if you look at a graph, the percentage of total reserves, what asset are they held in? Gold just passed US treasuries for the first time in 30 years. Countries are not wanting to hold the reserves in the US debt market anymore. And as a big part of that is confidence. It's all confidence, obviously, but the sanctions on Russia, the other conflicts going around in the world, the collapsing of China. So it's just safer in gold. And the reason I bring that up because it is scary, because you can see some downgrades in U.S. debt, but also that's got to drive up interest rates, in my opinion, because if you're issuing securities and the long-term security that the government issues is the 10-year, and that's how they price mortgages. So if you're going to issue long-term debt, the 10-year, and nobody wants that debt because they'd rather have gold, you have to pay a higher interest rate on that 10-year to get other countries to buy it. Am I thinking this through this correctly?
I absolutely agree. And I would put a fine point on the confidence word that you used, right? Because gold surpassing U.S. Treasuries as as something that's held by other countries, that is massively important. That's massively important because being the global reserve currency, having that status for our currency allows us a lot. It affords us a lot of positives. And on the
It
flip side,
allows us to print, right? I mean,
it,
that's
it-
what gives us the ability to do that.
because we always have a buyer of our debt,
Exactly
right?
right.
So when we print that debt and we issue our treasuries on the back end, there's always someone to buy it. Is the assumption that we've been going under for 30 years. 1971, when we got off the gold standard, what we saw is that countries were pissed. They're furious because now the dollar was pegged to nothing, right?
Mhm.
It was truly a fiat
A
floating
promise.
currency at that point. Yeah, and so
Back to
a
a promise. Yep.
promise. And we in 1971, very a lot of strong things going on in the U.S., especially comparatively in the world. We said no, we're going to do this 2% target for our central bank, the Federal Reserve, right? And now we're seeing that float further and further away from that with more upward pressures. So I don't blame other countries. Now,
Right.
the reason I would say I'm still bullish on the US after we just scared the shit out of
I'm
everybody.
sorry. I'm sorry. But that really surprised me, Nick, when I saw that. I was like, I didn't have any idea. I was like, ooh, this makes me question if mortgage rates will come back down. That's why I wanted to bring it up.
So the interesting discussion gets to what are the alternatives, right? Where else would you go? Let's say you really
That's true.
wanted to buy, a central bank's currency or excuse me, a central bank's treasury equivalent across the world. Where else would you go? Right? What other currency do you trust as much as the US dollar? And that's a very, very weak list, to be clear.
It's
So
like Japan, and maybe that's it. I don't know.
yeah,
I don't know the answer, but it's
and
not
their
big.
debt to
Yeah,
GDP ratio is what, like
worse than ours. Yep,
260,
for
right?
sure.
And so we're around 120, 130 in the US right now. That's going the wrong direction still, but still 120, 130. Japan in the 60-ish, 230-ish range. China's around there. If you add up all their debt, they brag like an 80% debt to GDP. No, they're like mid 200s if you add up all their debt and their regional and county debt.
Nothing that's true. None of that's true.
And you can't even trust their statistics,
Right.
right? You can't even trust their stats. So all that said, that's even what they're willing to report, which is going to be
Yeah,
a lot worse.
exactly.
And then what are you going to do? The euro, that's a fractured bond market, 27 different countries, 27 different bond markets. So no, it's not an equivalent to the US. So we're still the best. We're still the, front runner of all that. We still have what, AAA plus? We got downrated slightly. So where else are you going to go? That doesn't last forever. And we need to still wake up and earn that status every single day by having a balanced budget, by having our currency on track, by having our economy on track along the way that backs up this currency. So that's where I think the opportunity is. And that's why I vote economically is one, so that Americans can have a better quality of life, which leads to all kinds of great outcomes. Two, that they have more disposable income to have bigger families, which is a 30 plus year investment in the country. And then three, because if we lose this reserve currency status, we are in deep shit. It gets real messy. So I think the number one issue in the country today is literally a balanced budget, just not to beat around the bush.
I 100% agree with you. And I also find that these targets that you've referenced a couple of times interesting. So you said the 2%, which is very public. And then that's the PCE core. When you there's really four inflation numbers that they track. There's headline and core for both headline and core for both CPI and PCE. Sorry, and it's the core PCE. I think what is it, almost 3% right now. And I think you've said that.
2.7-ish, I think was last
Uh,
check.
but what's interesting about that is the long-term average is over 3%. I think last I read, the 50-year average was 3.2. So my question is, where does the 2% number even come from? And why is that? Why is 3% so much worse than 2? And then on the unemployment number, we're at 4.3 right now, and we're still at about a 1-to-1, one person looking for a job, one job opening. That's a very efficient market. Now, I'm looking macro. I know certain sectors are struggling, and I'm not trying to dismiss that or not be sensitive to that because I know there are people hurting right now. But if you're looking at the big picture, it's about a 1-to-1 and we're at 4.3. So I would make that argument that maybe you don't really get nervous about unemployment until you're closer to 5%. I don't think the numbers are as bad as people are thinking right now.
So I go both ways on that. I'll just give you a counterbalance, just a
Yeah,
counterbalance
I want
point
to
to
hear it
consider.
totally.
So the 1-to-1, I'm tracking with you on that point. Where I get concerned are the long-term unemployed, okay? And then the first-time jobless claims, right? The first-time unemployment claims.
Okay.
Those are the two numbers where I have major concerns. The first being that when you start drilling down into the numbers and the balancing act that go into the employment markets, when you see the long-term unemployed, unable to find jobs, let's quantify those numbers. 25% of people looking for jobs have been looking for over 6 months. So the trend question is, do we have a market that doesn't have placement for 25-ish percent of the job lookers at any given point in time? That's where it's much more difficult for me to look at it 1-to-1. Because if it was a 1-to-1 and the average, time to find a job was something like 90 days, I'd be like, yeah, I mean, still a hot market. Yeah, maybe less job creation. Yeah, 1-to-1. But that long-term 25% problem, I'm looking at that. And then you look at the younger generations. If you take, polls of Gen Z particularly, who really are not positive on the job market, and then you look at the correlation between having a college degree and their unemployment rate. There are college degrees, or excuse me, there are statuses of college where, I think it's like if you're a was it like a master's degree equivalent, your unemployment rate's like 9+%, right? These are scary numbers because the placement for these people on a long-term trend, that's where it gets scary. Historically, my family had kind of more of an immigrant mentality that like, look, if you can't get the job you want, you get the job you can, right? That's kind of, that was more of the discussion and you figure it out along the way. We don't even see that as a discussion today. It's, hey, I have a degree in this. I expect to be employed in this, and I expect to make a certain amount of money, and a serious expectation from the labor market. We're just not delivering on that, and
Do
it's
you,
much
yeah.
easier when there are more jobs to go around. But that's flipped dramatically. So that 1-to-1 actually scares me just with the long term prospect there.
I'm gonna agree with you that it's scary because I'm gonna tell you a stat here that I think may have been missed in the conversation. But to counterpoint what you just said, if we dissected that 25%, I would be very curious in what those numbers look like. I don't know the answer to that, but
I
how
don't
many
know
of
either.
those are Gen X, as you just decided, that have this participation trophy mentality, and they just think that they should get something for nothing? And I know I'm being harsh here, but I really think that there's a problem with people on the unemployment that are expecting something that's not realistic for them, and they're not willing to settle for something that they probably should be, just because they're so used to the entitlement
Hmm.
problem. So I wonder if we dissected that, how many of it are people on unemployment that don't want to go off unemployment? And here's another problem. Now that I'm going to go on a rant, the unemployment pays too much because people are not incented to go get another job because they get more if they're collecting unemployment. Why would you go get a job and make less? So I think there's more to those numbers than what you're alluding to here. So not to challenge you too hard here, but I'm just curious if you really dissected it, what that would look like. And then two, you had mentioned the 20 to 30,000 jobs per month number. What scared people and what tanked the stocks in that 1 month was the adjustment to June of this year that went negative, right? Negative 13,000. And then if you look at the year adjustment over 1 year, it's almost a million. So it's these adjustments that are coming back, and that well, and that's why Trump went on his little rant with the quality of the data. But so I mean, I don't really know. I'm just saying that I think a 1-to-1 is pretty efficient. Now, if we have these mass deportations and people aren't here to fill the roles, then that could create a whole nother slew of problems. But I think if you look in overall, the numbers look strong, but I do think they're trending the wrong direction. And I do know that unemployment can go and it can go fast. So you might see it go from 4.3 to 5.3 in a short period of time, and that would cause a problem. And I think that's why Powell has shifted the focus from inflation to jobs.
I no, I agree. I agree. I think he's definitely shifted the focus from the inflation concern to to boosting the job market. So what I always think about on the back end of this is, what do we do about it,
Yeah, I
right?
was going to just ask you. We're getting
Okay.
near the end of the episode, so we just scared everybody. It's not great. Let's just be honest with it here, but that doesn't mean there's not opportunities. It doesn't mean that our personal economy has to suffer. So tell us what we do.
So on my side, these are the three sectors that we're looking at. To be clear, just what we see as the biggest opportunities in the midst of all this, because we spend way too much time on economic data. We're way too obsessed with it,
Yeah,
but
bud.
it allows us to look around the bend with a higher degree of likelihood than if we didn't look at these numbers, right? The three that I like: one, it's going to be housing in the US. Single family homes in the US. I think if you every time you drill down into the numbers, there's a huge pent up demand. There's affordability that's a huge issue, right? A major affordability issue in the US. But there's still the demand there. There's still a shortage of 6 million homes. And I could, go into line by line, all kinds of numbers there. Number two, I do like industrial over the long term. You see two back-to-back presidencies, meaning both sides of the aisle, that have a major focus on manufacturing in the US. I think I wasn't in opposition to Trump doing some tariffs along the way. Although I think that the timeline on those, the further that goes out, the more stress that places on those deals getting done and other supply chains developing outside of the US. That would be the concern there. That said, I still think manufacturing in the US is a massive opportunity in the future. We're seeing Honda, Hyundai, Taiwan Semiconductor, all kinds of massive names doing
Data
US
centers.
buildouts. What's that?
Data centers.
Data centers. Yeah, I mean the recent announcement by Nvidia. You have Meta's data center X amount of months ago. So huge amounts of data, going in, huge build outs there. I still am extremely bullish on U.S. manufacturing and distribution and warehousing and logistics. And then third, I think multifamily. That's a bad word right now in some areas and some markets, and it's a fantastic word in other markets because you're buying deals with huge upside potential in the future, and it's just such a privileged asset class, whether it's the debt, whether it's the growth of certain markets, whether it's et cetera, et cetera. I think multifamily is very strong. So those three over a longer term trend, let's say 5 to 10 years, I'm still extremely bullish on throughout the real estate world.
Ah, that's interesting. I would tend to agree, and the industrial scares me a little. Although I am those data centers, that's a real thing, by the way. Lots of industrial spaces getting absorbed into that. But it also was so popular. I might have been overbuilt. I know we talked about this on the last episode, and at least in my market, we went from like a 2% vacancy to a double-digit vacancy in industrial, and that's even the flex space, which is for the listener, a flex space can be used for pretty much anything. It could be an industrial warehouse, or it could be office,
Yep.
or retail. It could even be retail. So, but we're seeing it struggle a little bit. I agree with you wholeheartedly on the other two, though, and it does come down to how both of those come down to housing. I know multifamily is more of commercial, at least that's how it trades, but it's a roof over someone's head. That's where they lay their head on their pillow. I think that there's a lot of strength there. So I agree.
So that's what we're looking at. If someone was to, look at the market and say, how do I, what should I be looking at in the alternatives world? That's what we're looking at with the highest degree of opportunity that we
All right,
see.
well, how do you help us with that?
Sure. So if people want to learn about us and what we're doing, they can check out saintinvestment.com, our website. We go into tons of detail there. We also do all kinds of free webinars on all these economic data points, analysis, et cetera. They can check those out at saintinvestment.com/resources.
Okay. This feels like this is so fun. This is one of my favorite episodes because I love talking about the economy. And it does impact us all. And I'm very protective of my money, like we all are. And not knowing what's going on in the world, I think could be a huge detriment to your personal economy. So I think listening to episodes like this and just being aware helps you become a better investor. So I don't know if you'd be open to it, but we should probably maybe schedule these every year,
Absolutely.
just hang out and we could talk about what's going on. I love it how we don't always agree, because that's real life. And look, we don't know what's coming, right? We don't know if interest rates are going up or down. Now, I could tell you why I think they're going a certain direction, but I don't know that. But I love having you on, man. I was just gonna say, you said Saint. What was the website again?
Saintinvestment.com.
Saintinvestment.com. Any final words for our listener today?
I would say that the economic forecast, the economic trends that we're seeing today, the number one takeaway is to support and push the government towards balancing the budget. That affects us all from top to bottom. That's the number one thing I have my eye on. And then along the way, to be optimistic about the fact that even if we beat up the US here, even if we're comparing notes on a lot of stuff that's really tough topics, the reality is if you compare our core economy, our fundamentals to the rest of the world, it's so much more solid than other developing countries, other developed countries, other mature countries. So I really see us as the best opportunity over the next 10, 20, 30 plus years in the US. And really, it's just about getting these things done today that can keep that trend going into the future.
I totally agree with you. So, Nick, I know you're super busy running your 200, whatever it is now, assets under management. You're doing great things in all three of those sectors. I know you're involved in all three of those, and that's
Yep.
why you're bullish on them. You're busy, and I appreciate you coming out and sharing your wisdom again, once again, with our audience. I'm not kidding when I say this. I really enjoy talking about this stuff with you. So, thank you so much for coming on.